So Louis, it's great to see your smiling face. It's been way too long.
It has been. I'm a little intimidated by your boxing gloves. I'm wondering if I'm about to get beat up here.
On the contrary, no, those are definitely meant for our friends at the Fed.
Okay, good. All right.
We'll talk about that toward the end. But, so you've had a good summer. You've been over in France a fair amount, right?
I was over in France for a few weeks, enjoying the heat there, and yeah, no, it's been a good summer.
And you saw Charles, your father, and your mom.
Saw Charles, yeah. Saw my parents. My kids did different camps to try to crank up their level of French, which isn't exactly at the level it should be. It's good, but not great. So trying to crank that up, and no, overall a productive summer.
Excellent. That's good to hear. So we'll come back and talk about Europe. You maybe have some special insights having been over there. But first of all, I wanted to thank you for being the inaugural guests for the Haymaker podcast series. It's just so appropriate that you're the man.
I'm very flattered.
You give it well. We're the ones that are honored. This is a great way to kick off the series. We're hoping that it's going to be a series that runs for years to come, frankly. So again, thank you for being with us at the very beginning. So I thought it'd be appropriate to talk about the early days of Gavekal and how it got going in Hong Kong during a time of truly epic asset price destruction. And as I recall, the price of homes in Hong Kong fell 70% during the 1997, 98 Asian crisis period.
Yeah, and between 97, the bottom was really in 2003 with the SARS crisis. Do you remember SARS?
Oh yeah, absolutely.
Unlike COVID, it actually was a very deadly disease. Fortunately, it wasn't as contagious as COVID. But so yeah, between 97 and which was the Asian crisis, and 2003, which marked the bottom with SARS, that was about a 70% drawdown in Hong Kong real estate prices, which was quite something to live through. And I think impressively, not a single bank went bust.
It is amazing.
And I think I took the wrong lessons from that initially. Going back to the 2007, 2008 crisis. When real estate prices in the U.S. started to go down 10%, initially my take was like, yeah, so what? So that's like it's peanuts. And then all the banks went bust with 10% real estate price correction. So I obviously initially took the wrong lessons from the Asian crisis.
Well, it's understandable. It was, but it is an amazing factoid that not a single bank failed, and actually kind of similar to what happened in the global financial crisis in Canada, where not a single Canadian bank even cut its dividend, and yet the U.S. banks were dropping like flies. And that's an interesting topic that we may get time to get back to, and that's certainly a big part of my book, and we'll talk about that a bit at the end. But how about the stock market? The stock market also got crushed in Hong Kong back then, right?
Oh yeah, no, look, it was definitely a wrong time to be exposed to Asia. And going back to your question on the genesis of Gavekal, back in the early days of the Asian crisis, I was working for a French investment bank that had sent me out to Asia, a bank called Paribas. And with the Asian crisis, like most banks, Paribas retrenched. Initially, I went back to London, but I was really missing Asia. And to me, it seemed pretty obvious that there was a massive gap in, on the one hand, the importance that China would take for the global economy, and on the other, both the amount of time and, frankly, expertise that most Western investors brought to the question of dealing with China. So I thought there was an interesting niche here, perhaps to exploit, especially since, because of the Asian crisis, most Western investment banks had actually left Asia or reduced their team there to absolutely nothing. So yeah, we set up Gavekal with my friend Anatol Kaletsky, my dad. Initially, we were three of us, four if you count my dog. That was. I was going to say
your first employee turned out to be quite a dog, right?
Yeah, and he stuck around for 16 years, which for a golden retriever was pretty good. And you might think he was a cheap employee, but he really wasn't. I don't know if you've ever had a golden. I know you've had lots of dogs, but he definitely came with his share of vet bills. I know you've had dogs with their shares of vet bills. I think all in all, I'd put the price of a sports car in that dog. No. So he initially we started the 3/4 of us, and we were lucky enough to be honest, to be in the right place at the right time, because obviously China took off, and pretty quickly every money manager around the world realized, hold on, I got to understand what's going on there. Even if I don't invest in China per se, what China does ends up impacting the commodity markets. It ends up impacting the interest rate markets. I cannot not know what's happening there. So we were, in the right place at the right time. And as the business grew, we just kept reinvesting and trying to understand China. So we opened an office in Beijing. We bought stake in other research businesses. One of them called Fathom does corporate due diligence in China. Another called Red Tech does research on Chinese tech stocks. So we really, I guess, went down the rabbit hole of trying to figure out what's happening in China, and we're still doing it. It's still a full-time job trying to figure out what's happening over there.
Yes, it's definitely not boring times. It was the old Chinese saying, right? May you live in interesting times. And
I think I think John Kennedy made up that quote.
Oh, really?
Yeah, it's not a Chinese saying. Like Westerners love to quote it. It's actually John Kennedy made it up on a stump speech, and since then it's stuck around.
You mean a politician actually fabricated something? That's so shocking.
Yes.
Well, let's talk about, speaking of fabricating and fabricating narratives, let's talk a bit about our friends at the Fed. There's a big speech tomorrow from Jay Powell at Jackson Hole. And one of my questions to you is, do you think he's going to try to punch a hole in this mini bubble that's been inflating since the latter part of June, when, as you had a great visual, which I've included in some of my other Haymaker pieces, and that showed basically the biggest wealth wipeout in the first 6 months of this year, really since the 1930s. It was worse than the COVID panic. It was worse than the Great Recession and the global financial crisis. And it's because people were losing money on bonds, they were losing money on stocks, they were losing money on crypto, and of course, recently now losing money on real estate. So lately, though, there's been this huge resurgence. We've had a rally in junk bonds. We've had a rally in the profitless tech. We've had a rally in the meme stocks. We've had a rally in some of the large cap tech names. It's been like we're back in a bull market. And I don't think that's what the Fed wants to see. And do you think that that's going to affect Powell's thinking and comments tomorrow?
Man, you're putting me on the spot. You know the old rule. You either have to make you either decide on a time or a level, never both. So you're putting me on. You're putting me on the spot. I actually think Powell's going to try to make a speech as uncontroversial as possible tomorrow, and I don't think he wants to rock. No, I don't think he wants to. To answer directly your question, I don't think he wants to rock the markets. You've had a lot of softer economic U.S. data in the past few weeks and months. You have all the hallmarks of a significant crisis unfolding in Europe. You have clearly the signs that the stronger U.S. dollar is starting to inflict serious pain around the world. Now you could say it's countries that aren't that important, like Sri Lanka and Pakistan and Laos and Argentina, all basically hitting the walls in recent weeks. But it does speak to the fact that we are in this liquidity crisis. You remember my old analogy that liquidity crises are a little bit like dynamite fishing, right? Initially, you throw a stick of dynamite in the sea, and initially you see the little fish come up. And we are seeing the little fish come up, the Sri Lankas, the Argentinas of this world. And when you see the little fish come up, there's a good chance there's a whale that's dead underneath there. You just don't know it yet. So I think if you're Powell, you're probably thinking, is there a whale? As you start to see these little fish come up, is there a whale underneath there? So I think he's going to try to make a speech as uncontroversial as possible. And I think the market will interpret that as being a dovish speech. If he doesn't come out very hawkish, clearly the market's biased right now. To your point, the rally in meme stocks and crypto, etc. Right now, the market wants to see the dovishness everywhere. So unless he gives the market a reason to think no, I'm really hawkish. They're going to go the other way. And so I would expect that following the Jackson Hole speech, you're going to see a bit of a rollover in the US dollar. You're probably going to see a big rally in the beaten up precious metal stocks on the premise, oh, the Fed is turning dovish, even if it's not. And you're going to see a continuation of the rally in energy. And clearly, to your point, that's probably not what they want to see. So they'll have to correct course again in September or October. But at least that's how my expectations. That's how I'm positioned. I've actually been buying some precious metal stocks in the past week on the premise that he was going to sound. The market would interpret his speech as being dovish.
I'm glad there's one other person on the planet that's buying those. You and me. About it.
There we go.
Well, it's,
yeah. When you look at that price action, it must be just you and I.
I know. Well, to be clear, when our subscribers and readers and listeners hear this, it's going to be after Powell's made his speech. So
great. So I'll get to look foolish. That's awesome. Thanks, Dave.
But I think maybe who could look the most foolish is Mr. Powell, because I think he's really got a problem. I mean, I do think this resurgence of speculation in the financial markets is exactly the opposite of what they want. But as you mentioned, and we're going to talk about more, what's happening with economic data is really problematic. So it's like for the economy, they shouldn't tighten, but for the financial markets, they should. So they've got quite a dilemma on their hands.
Well, let's take a step back here, and let's ask ourselves, what fundamentally do we think the Fed's mandate is? Now, most people would say, oh, it's easy. It's price stability and economic growth. It's the dual mandate. But what have they done in the past 12 to 18 months that leads you to believe that they take their inflation mandate seriously? Inflation started to move above the sort of 2% range more than a year ago, right? It started to move. I think if I'm quoting from memory, but I think it was in March 2021. It broke above.
Exactly.
It broke at 3%, and then the following month it was 5%, etc. Like, if they were serious about inflation in April and May, they should have been already said, all right, no more QE, and we're starting QT. But for the following 12 months, from May 2021 to May 2022, the Fed balance sheet kept on growing. They kept on doing QE in the face of inflation numbers that were above 5%. So clearly, I mean, if you judge people by their actions, not by their words, then clearly their actions tell you they don't really care about their inflation mandate. Now, why would you continue QE in the face of 5% inflation, 5% plus inflation? It brings me to what I think is now the Fed's real mandate, and by the way, also the ECB's real mandate. And the Bank of Japan has come out and said it. The real mandate is to governments. They are now, for years, people have been talking about making the central banks branches of the Treasury, but it's happened. This is where we are. The central banks are there to help the governments roll over their debt. And Japan has come out and said it, right? Oh, look, we're going to do yield curve control. We want to make sure that the government can fund itself at a cheap price. Everybody sold the yen. And everybody says, the Japanese, they're crazy, etc. But in my whole career, I've seen the Bank of Japan, start a policy. Everybody tell them that they're crazy, and a few months or a few quarters later, we do it. Like zero interest rate policies. Zero interest rate policy. Well, that's just stupid. Like, who does zero interest rates? 2 years later, everybody's doing zero interest rates. QE. Japan was the first to do QE, quantitative easing. Oh, well, that's stupid. Who's going to do QE? A few months later, everybody does QE. Negative interest rates. That's even more stupid. That's even more crazy. Everybody was like thinking, how could this happen? And then, before you know it, the ECB, the Swiss National Bank, they're all doing it. So here we're all looking at Japan. Oh, yield curve controls, that's just silliness. Let's not kid ourselves. That's where we're heading.
Well, I've heard you say before that this inflation isn't a bug, it's a feature. And it's how the U.S. government deleverages, because we talked a little bit about the entitlement bomb. And so really what you're saying is, one of the things I was going to lead into is that the Fed's got a stealth mandate now. I mean, their obvious mandates are to keep inflation low, to keep unemployment low, which is tough enough because they kind of work at cross purposes. But now we've got this other stealth mandate, which is to fund the deficits. And those deficits, Wall Street Journal had an article this week saying the U.S. deficits are down substantially, which they are, to about $1 trillion. It ain't great considering the enormous surge in revenues. Revenues,
and consider where we are in the cycle.
Yeah, exactly. And revenues were record breaking, and yet we're still running $1 trillion deficits. But what's interesting is what you see happening with tax receipts. All of a sudden, tax receipts are dropping rapidly. They were down 16% at the federal level in May. That could be maybe a one-off month, but I kind of doubt it. California in July, which is just a state, but it's a very important state, they saw a 20% drop in tax receipts in July. So there's definitely some signs that the fiscal situation is going to deteriorate. So yes, I think that's a very important point that you're making. And it sounds like you believe in the United States that we're going to have yield curve control eventually.
I do. And look, I think in essence, we don't say it in Europe. I guess in Europe, we don't have yield curve controls as much as attempted spread controls, government spread controls.
Right?
We have yield curve control in Japan. And look, you've given the amount of debt you have in the U.S. and the amount of budget deficits that you keep piling on every year, adding to the debt, to think that the private sector can digest all that, to me, is a stretch. So there's only two ways when you look at the progression of debt in the U.S. Either the central bank has to step in, or there needs to be, I would say, rolling crises around the world that make it so that all the foreign savings go into the U.S. treasuries. So, this year, obviously, we've had the Ukraine-Russia crisis, which, scares everybody. So you rush back into the dollar and rush back into U.S. treasuries. This winter, we're going to have a massive European crisis and, probably big strikes and big supply chain dislocations as the power goes out all over the continent. So this might lead to, more money flowing into the U.S. dollar and U.S. treasuries. So maybe that's how the U.S. government keeps funding itself. But after that, what happens next? What's the next crisis that will mean, I want to take shelter under the warm blanket that the U.S. government provides for me? Because if there isn't one, you're dealing with minus 5% real. It's not an attractive proposition. There's no reason to be there outside of fear.
Well, you're bringing up, at least you're heading the direction of a very important point, and what I call the entitlement bomb. And it's staggering to think about what the big three are. The big three being Social Security, Medicare, Medicaid. So just those three alone, in terms of annual outlays, is about $2.8 trillion. And of course, the Social Security is now indexed. Well, has been indexed, but it was one thing when inflation was 2. Now that inflation's 9. That cost of living adjustment on the Social Security outlays is going to be huge. And then with Medicare and Medicaid, the way healthcare expenses are exploding, you're probably looking at a $280 billion, roughly a 10% increase in those outlays because of inflation, or at least inflation-driven cost increases. So, how do you, and of course, the thing that I've harped on this many times in what I've written and what I've said is, how did we not fund the Social Security or the Medicare, Medicaid trust funds with real assets? How did we not do that when they were running massive surpluses for years? So now what we have in there is we have more government bonds. And people say, oh, those are the safest assets on the planet, right? But now that they're running deficits, they're going to have to start selling those bonds to get real money to pay those, those costs. And then you've got QT happening at the same time. And so how does this entitlement obligation that we've kicked the can on for so many years get resolved?
Well, to answer your question on how did we not do this in the past, I think the answer is obviously, Ponzi schemes, because at the end of the day, Social Security is built as a Ponzi scheme where yes, as long as more people come in than people leave, then you're fine. For the longest time, the demographic picture of the United States made it so that funding through Ponzi's was an attractive proposition. Because you always had more people coming in than people leaving. I think what's happened in recent years is that the demographic picture is changing rapidly in the U.S. for a number of different factors. Obviously, there's the people's lifestyle choices, having fewer kids, so that's one of them. There's the rapidly changing picture on immigration, where immigration has become a big social issue, and so you now have fewer immigrants. But part of the reason you also have fewer immigrants is demographic growth is slowing all around the world. China, the past 3 years, has actually been losing workers, not adding workers. So China was one of the places where people would immigrate from to go to the U.S., right? And you'd have Chinese people who would come to the U.S. and immediately contribute into Social Security, immediately contribute into Medicare, Medicaid. That's pretty much over. You have few places in the world that are still growing rapidly demographically. So the whole immigration picture is evolving. And then I think in the U.S. you have an added thing that perhaps is less prevalent around the world, but you have a real healthcare issue in the U.S. in that you have a real obesity problem. You have a large percentage of your population that's obese, and therefore no longer able to work because of the obesity. And our mutual friend Vincent Deglobalization has written some very interesting pieces on this, crunching the data. But if you count that, let's say 3% of your population can't work because it's frankly too fat, and instead goes on Medicare, Medicaid, that completely tilts the balance. That like screws up your models. And we're there. And so you end up with curves in the US where you look at, healthcare spending in the US per capita is higher than everywhere else in the world by a long shot, by multiples.
By about 5% of GDP.
Yeah, with inferior health outcomes, right? And the US is one of the few places when you look at average age of death, which keeps on creeping up everywhere in the world. In the US, it's flatlined. Now, I think the US has also had a fourth issue that's hitting Social Security, Medicare, Medicaid, is you have 1.5% to 2% of your workforce that is becoming obsolete because of drug abuse. It's the whole, fentanyl and the opioid crisis. So you add it all up, and a system that was probably finely tuned and finely balanced to work under certain conditions. You load the donkey enough and the back breaks. Between lack of immigration, demographic transition, obesity, opioids, boom, it no longer works. And that's where you are.
To your point, one of the most amazing factoids I've seen lately is from the New York Times that almost a third of adult Americans have a criminal record. Maybe some of those are, drug charges, misdemeanor types of things, but it's tough to get a job when you have that kind of baggage. And you've got a little bit over 100 million Americans that are of working age that are not in the workforce. 100 million. That is a staggering number. So you're right. But it all seems to me to get back to the point that how do these entitlements get funded other than through the Fed's magical money machine? This
they can't. Or the only way, it's either the Fed magical money machine or funded by foreigners. Foreigners who are afraid that the world outside of the US is too dangerous, and therefore I best keep my assets in the US.
That's important. Really, go back to that one. That is a really important point. But also, this is, I know that the topic of a US recession is hotly debated within Gavekal as it is at our firm, Evergreen, your partner firm. We have very strong opinions. And earlier in the year, I was of the opinion that we were going to have a lot of growth and a lot of inflation. Well, I got the inflation part right, not the growth part right. I did shift my thinking after the Ukraine invasion. But we were talking about this earlier. It's pretty shocking to look at the deceleration of the U.S. economy. In my 43-year career, I don't think I've ever seen it decelerate as rapidly as it has. And if you look at, in fact, we've got a chart. This is going to be our first image that's going to pop up here for viewers showing U.S. manufacturing activity from this firm you may be heard of called Gavekal. This is a Gavekal chart, and it's showing a cliff dive by manufacturing activity. We've got leading economic indicators down for 5 consecutive months, and if you look historically, that always leads to a recession. The New York Empire Fed survey was horrible. The services PMI was 44. 44 is a really low reading. So they've had bad earnings report this week out of Nordstrom's, which is supposedly better insulated, right? Because it's a higher end consumer that is typically their customer. And Macy's wasn't good. Toll Brothers, the builder, their new order book is down 60%. The housing market is just in free fall. And now rates are going back up again. So how would, I mean, this is, again, putting you in a tough spot here, asking you to put some odds on this, but I mean, are you leaning towards, if we're not in recession yet, we will be soon?
Well, Nordstrom. My wife was in France, so perhaps that's
That's it.
that explains that. That's a month of the no. Jokes aside, look, you and I have discussed this many times, but my core belief is most economic activity is energy transformed, and a cheaper cost of energy is very bullish for growth, and a high cost of energy is a big drag on growth. A lot of manufacturing, to your point, and on the collapsing on that chart you just showed, a lot of the collapse in manufacturing, I think, is partly linked to the fact that as energy prices shoot up, some things are no longer worthwhile making, economically speaking. It's no longer profitable. Now, I think when most people look at energy, they look at the oil price, right? Because it's the one we're all familiar with. It's the one we see every day because we drive by gas stations. Even if we're in an electric car, you see the gas price. And the higher the gas price goes up, you can gloat in your electric car that you don't have to pay it. So that's the price that we all see. But it's only a small fraction of the energy cost, right? And for industry, what matters more often, of course, is electricity, is natural gas, and it's coal. And these prices, just as oil has basically been between 90 and $100 since February, natural gas has continued to rip higher, coal has continued to rip higher, and electricity prices have gone absolutely parabolic in Europe, as I think we have a chart on that as well.
We do. We'll run that chart right here because it is absolutely astounding, and I think most Americans have no appreciation. So this, again, is one of these stunning factoids that the price of electricity in Europe right now is equivalent to $1,000 a barrel oil. Natural gas is equivalent to roughly $400 a barrel oil. I mean, Americans, just imagine what would happen to this country if we were having a hard time with gas prices at $5, which have now receded back around $4. It's just staggering what's happening. So,
but look, if you're living in Italy, if you're a manufacturer in Italy, your electricity price, because very often the consumer is kind of cushioned because the companies can only raise so much, but the corporate buyer, he pays market price, right? And manufacturing, in Italy, you have electricity bills that have gone up 10 times for manufacturers. In Germany, they've gone up 5 or 6 times. France the same. In the UK, where the consumer is less sheltered, you now have electricity bills that are bigger than people's monthly salaries. Like people are, coming home and getting monthly electricity bills that are bigger than their monthly salaries. So obviously, none of that is very conducive to growth, right? Like, when you get an electricity bill that's more than you earn, you're not going to go to the restaurant, and you're probably going to cancel that holiday. So I'm sorry, it's a very long-winded answer to your question, but as I look at the evolution of energy prices, I'm not that surprised to see the rollover in a lot of the industrial production stuff. And for me, for that sort of downturn to stop, you almost need the energy price to stop rising. So I don't want to make like a Jesuit priest and answer your question with another question, but your question on recession is, for me, inherently a question on energy. Do you think energy prices continue to grind higher over the winter? In which case, I don't see how we avoid a recession. Or do you think that by some magical hit of a wand, they start rolling over now, in which case we can get a pickup in manufacturing in the second half of this year? My personal belief, when I look at the supply and demand situation, and especially the supply situation, is I don't see how energy prices roll over meaningfully. Maybe at best they roughly flatline. Maybe they can pull back a tiny bit, but I still think we're heading into a very tough winter on the energy front. And with that, you have a few gray hairs. You've been around the block. Now, when have you seen a significant rise in energy prices and a significant rise in interest rate prices not lead to a recession?
Well, since I went to a Catholic grade school, I'm used to answering questions. So, yeah, I think you're on the right track. In fact, I think it's even worse than what you're saying, because I think if you roll back energy prices by 50% from where they are today in Europe, it's still going to cause a recession. They're so unbelievable. I mean, you talk about gray hairs. I mean, I do remember the 1970s. I was actually in the business at the very end of the 70s. I caught that second oil crisis, but I was an investor in the early 70s when we had the first one. This is like nothing I've ever seen. Again, America is insulated. Thank God we've got fracking and shale, and we've had 9 million barrels of new oil that's been discovered because of that process. We're a natural gas export.
And you could be even better off if you accept Canadian pipelines.
Absolutely. We can't even complete our own pipelines, although there's finally hope for Mountain Valley. But anyway, what's happening in Europe is it's like nothing I've ever seen. I don't think there's ever in the history of mankind been an energy crisis as intense as this one is. And what's interesting is actually was underway. One of the chapters of my book on this whole topic of greenflation and the great green energy transition we ran last fall. And last fall, energy prices in Europe were already going nuts. So, I asked my friend Grant Williams earlier this year what he thought the odds of a recession in Europe were, and he said over 100%. And statistically, that's not possible. You got to say it's 99.99 right now. So I think we're on a similar topic there. But so let's segue again to energy, because I think it's been a fascinating period here with oil prices. Because while we've seen natural gas prices in the U.S. get up close to 10, at least on the spot, the strip's a different story, if you average it over 12 months. But then oil has gone down. It got into the low 80s. I'm sorry, not low 80s, mid 80s here recently. And even today, it's 93, 94, something like that, which is when you inflation adjust it versus where it was even 15 years ago. I remember when it was $80 a barrel back in 2006 and 7. Nobody really thought that was any big deal. So really, on a relative basis, oil is an incredible bargain. And I did a podcast here recently with a very bright guy, and he's an energy expert. And his big thing to me was, "Oh, you don't get it, David. There's demand destruction coming because of this global recession." And I said, "Yeah, I think that's true. We're going to have a global recession, but it's the demand destruction that I think is very unlikely because Europe is in such dire need of U.S. oil or North American oil, Canadian oil as well." So, what are your thoughts in terms of that? And well, I guess I could just give you one little quote here this is from the IEA, which is consistently and significantly
underreporting demand.
Pardon me?
They always underreport demand, the IEA.
Exactly. They have underreported hundreds of millions of barrels over the last almost 10 years. But here's what they said. A looming natural gas crunch in Europe is already incentivizing substantial gas to oil demand substitution. Something that's never happened. And the reason it's never happened before, this is one of my big
things. The other way.
Because oil was too expensive. The switching was always from coal to natural gas or natural gas to coal. But now, as you pointed out earlier, they're so expensive relative to oil. And I think it matters because you've had a fairly significant sell-off, not only in oil, but also in oil and gas securities. So just kind of what's your overall take on energy, and why do you think that's where people should be overweight?
Look, I think first, the energy space outside of oil, as I was mentioning earlier, has done great, right? Natural gas has powered higher. Coal has been tremendous. So it's oil that's been struggling. And I would say that if you think of the past few months, 3-4 months or so, everything has been thrown at oil, right? Like all the potential bad news one could think of has been thrown oil's way. So first, China's continued lockdowns. If you had told me a year ago when the world was starting to, or a year and a half ago once the world has decided to reopen, et cetera, that, China's going to, continue with the lockdowns and continue, shutting Shanghai down for an entire month, and nobody's allowed to leave their apartment. Shanghai, that's, 20 million people, most important economic center in China. Right, it's going to be completely shut down. Oh, and by the way, oil will be $90. I said, you're crazy. Like, it's either or, David. Like, either China shuts down or we get oil at 90. You're not going to get both. But we did get both. You've had Biden visit, eat humble pie and go to Saudi Arabia with all the headlines. Oh, Biden's getting the Saudis to produce more, et cetera. Now, of course, all these headlines are now being walked back. But at the time, that was portrayed as a big deal. You've had all the headlines about Iran coming back on stream because a deal is going to get cut with Iran. You've had all the headlines on Venezuela coming back on stream because a deal is going to get cut with Venezuela. You've had the recession fears as you highlight, and And of course, you've had the Strategic Petroleum Reserve
million barrels a
being
day.
sold, which, which perhaps explains why natural gas and coal are going up and oil isn't. So you put all this together, and perhaps it's, I would say oil's been pretty impressive holding $90. If at this point you're thinking, okay, unless we have another Armageddon, another sort of global shutdowns a la COVID 2020, which, by the way, I don't think populations will accept. They accepted it the first time around because they were taken by surprise. But populations aren't going to fall for it twice. So at this stage, you really have to paint a picture of global economic Armageddon for me, I think for oil to go lower. So no, I think the oil, I take a lot of comfort in the way that oil has behaved in the face of all this. And as oil pulled back, the energy stocks got crushed in June, but pretty quickly they found their floor, and they had a decent July, and now they're outperforming in August. It's for me that big June sell-off, with the benefit of hindsight, people will look back and say that was a massive buying opportunity. And look, in general rule, when the government sells, you should be looking to, it's like you should be looking to buy. And in June, the government sold a lot of oil, and it's like, okay, when the Bank of England decided to sell all their gold reserve at, I can't remember what it was, I think it was $320 an ounce. I'm quoting from memory. That was a great opportunity to buy. When governments sell, they seldom sell at the best price. So
that's a very good point.
Yep.
So I think what you're saying, I don't want to put words in your mouth, correct me if I'm wrong about this, but you're saying that you think we have structurally higher energy prices, therefore we have structurally higher inflation, and perhaps structurally lower, at least real growth, nominal growth being a different story, like what we're seeing this year. A lot of nominal growth, very little real growth.
Absolutely. So I'd go one step further, Dave. Sorry to interrupt, but I think when you look at the past 10 years, basically the 2011 to 2021 period, that decade, that people say, oh, it was all about American ingenuity and about tech and about things being, the U.S. being such a great place for entrepreneurs and the startup of new companies and all that stuff, all of which is true. But the real huge macro development that people forget was that during those 10 years, the U.S. moved from 5 million barrels per day to 13 million barrels per day, thanks to the shale revolution. And with that, the U.S. trade balance improved dramatically, which led to a stronger dollar. And it wasn't just oil; it was also natural gas. The price of natural gas absolutely collapsed. So that was all of a sudden a huge comparative advantage for the U.S. because they had a cheaper cost of energy than everybody else. So industry moved back to the U.S. The U.S. boomed. Again, having the cheapest cost of energy around is the biggest comparative advantage there is, or one of the biggest comparative advantages there is. And so the U.S. had this from 2011 to 2021, and the shale revolution, it led to low U.S. inflation, improvement in the U.S. trade balance, which in turn led to a strong dollar. So if you were the Fed, you thought, oh, this is great. There's no inflation. The dollar is strong. Hey, let's just print a bunch of money. Why not? Let's just QE1, QE2, QE3, QE infinity. Let's just do it all day long. There's no consequences. And as you do this, of course, asset prices go up, and everybody says, "Oh, the U.S. is the best place in the world. We've got the best entrepreneurs. We've got the best this, the best that." And all the world's money comes to the U.S., and this is the story of the past 10 years. Lo and behold, the shale revolution is now over. The U.S. was producing 13 million barrels 3 years ago when oil was at $50. And now that oil is at $100 or 95, the U.S. painfully produces 11.8 to 11.9 million barrels per day. And with that, and the natural price of natural gas goes up. And lo and behold, as the energy price goes up, what do you know? Inflation goes up. And so now the Fed is in an opposite situation where instead of having this sort of structurally lower inflation thanks to falling energy prices and boom to the economy, it goes the other way. And so now the Fed is in a bind, but everybody is still in the U.S. All the foreigners that said, "Oh, the U.S. is the greatest place, let's invest there," all that money is still in the U.S. partly because outside of the U.S. looks worse. Like, the fact that the shale revolution is over is a bit of a bummer for the U.S. It's a disaster for Europe. Europe's entire energy equation was, oh, it's okay, we'll get cheap natural gas from Russia. Yep, that doesn't work. So what next? What now? There is no other what now. There is no what next. That's it. The plan was get cheap natural gas from Russia, and if we can't get that, we're screwed. That's it. So it's game over for Europe.
Well, right now they've got a saving grace, although I don't think the saving grace is going to last that long. That's what I talked about earlier, and you've touched on too, is that the price of oil is actually quite reasonable. And the great thing about oil, the gas is tough to ship.
It's easy to move. Yeah, it's easy to move.
And it's even once it gets to Europe, it's easier to distribute, because once you get the gas, the LNG, which is very expensive to go through that whole, liquefaction, then regasification process, and then the pipeline network for natural gas isn't that great in Europe either. I mean, it's great coming out of Russia, but that's about it. So oil's going to be their savior here for a while. But frankly, there's not that much excess oil in North America. So that at some points, that's why I think oil prices at 90 or 95 are unsustainably low. But regardless, I think we're saying from the same hymn book here that we think that structurally inflation is going to be higher. I mean, if oil in the United States is going to work its way back up to 120, 140, 150, and it was 140 in 2008, adjusted for inflation would be 170, 180, something like that. So we do have a chart from Gavekal on the likelihood that the U.S. is looking at structurally higher inflation. So that's a good time to take a look at that visual, and it's a good segue actually into the next topic, which is whether inflation. Because the debate right now is pretty intense. There's been some signs that inflation's peaking out. I think a lot of that was because of the correction in energy prices, particularly gasoline. It cooled off the CPI. But do you believe, the Fed clearly believes, the markets clearly believe that inflation is going to recede back to 2 to 3% in relatively short order? I don't think you believe that. I don't believe that, but I want to hear your take on it.
I don't. Look, it all depends. I think your take on this depends on what you think caused the inflation in the first place. So if you're of the school of, oh, well, today's inflation rate is linked to the supply chain dislocations, and as the supply chain dislocations solve themselves, then we'll come back to where we were before. Sure. I tend to think, hold on, if success has many fathers, so does inflation. And today, there's lots of reasons behind today's inflation rates. First and foremost for me is the trend towards deglobalization. What was the biggest deflationary force in the world for the past 20 years? It was globalization. It was the fact that, you could always tell the worker, hey, listen, if you don't like this wage, I can get a guy in China to do it for a fourth of your price or a third of your price. Well, that's no longer true. That's no longer true because you no longer have that excess workforce in China. And because you no longer have that excess workforce in China, the Chinese government policies have shifted. They're no longer all about being nice to the Western world because they want Western companies to come to China and create jobs here. They don't need those jobs anymore. It's that old country song to take this job and shove it. That's basically becomes Xi Jinping's mantra. So you no longer need to be nice to the Western world, and as you're not nice, the Western world starts to fight back as well. So you're in the midst of this deglobalization trend. When I described in my books, Clash of Empires and Avoiding the Punch. So deglobalization is one of them. To be honest, the crazy fiscal and monetary policy is the other. To think, I think there's 400 PhDs working at the Fed, give or take. For them to think that, we can expand the broad money supply in the U.S. for 35% for 2 consecutive years and there won't be an inflation consequence. I look at this and I think either all 400 didn't take Econ 101, which seems unlikely, or they did it on purpose. They wanted the inflation, as you and I have discussed. The inflation is not, it's not a bug, it's a feature. Now, granted, I think they thought, we'll crank up the inflation to 4%, and that's how we'll pay, we'll unwind the debt over time. The big problem is that inflation is inflationary, as our mutual friend Vincent, who I've already quoted, likes to say. There's a whole psychological element to it, and 4% leads to 5, leads to 6. It's like saying I'm going to be a little bit pregnant. You start off a little bit pregnant, and then 9 months later you're big pregnant, and then you have a problem on your hands for 18 years. That's what if not more, 18 years if you're lucky. And that's what inflation is. So we've put our hand in the inflation cookie jar, and let's be honest, like they're not doing much to close the cookie jar back. Like I said, you look at the Fed balance sheet. They stopped growing it in May, but they haven't shrunk it. For all the talk about QT, you've seen nothing yet. The Fed balance sheet has been flatlining since May, in the face of 8% plus inflation. So, why you haven't seen a big change in fiscal policy. Fundamentally, governments are still spending more money than they have, and even finding new ways to spend more money than they have with, forgiving of student loans and a $750 billion inflation fighting plan. So, the debt continues to pile on. The central banks aren't shrinking their balance sheets. Deglobalization marches on. The energy crisis marches on. And with the energy crisis, in fact, I think what that opens us for is more supply chain dislocations. Because this winter in Europe, you will have factory shutdowns. Now, if you look at, for example, the auto parts business, that's a huge business for Europe. You take most of the cars around the world, there'll be European parts in those cars. And if those factories can't get power, then you don't get a car. It's the old story, right? It takes about 1,500 parts to make a car. And if you've got 490 parts, you've got a paperweight, a very expensive one. So, you're missing a couple parts in your car. That's it. So, you look at the energy crisis we're rolling into, and to assume that we're done with the supply chain dislocations, to me, seems a little bit like a second marriage. It's the triumph of hope over experience.
Well, that's all very logical. And the last visual we had was showing the performance during inflationary periods. It's actually, I think, one of your dad's charts. And I guess where I'm going with this is, are most investors properly positioned for this more sustainably inflationary world that we're in? And I have my opinion, but I want to hear yours.
I would say, look, building a portfolio is like building a football team, right? You need different assets to do different things at different times. When you don't expect your offensive lineman to be the fastest runner on the team, or to be able to pass the ball or catch a ball, and you don't expect your quarterback to be the best tackler out there. Everybody's got different jobs, and the same is true of a portfolio. Now, the real challenge is, as you move from a deflationary environment to an inflationary environment, the challenge every investor has is, how do I put anti-fragile assets in my portfolio? For years, for most of your career, definitely all of mine, government bonds were the ultimate anti-fragile asset, right? You could count on them when things went bad. Government bonds saved your bacon. But as you highlighted when we first started talking, this hasn't happened in the past year. All of a sudden, equities and bonds are correlated, which is what happens in inflationary environments. So bonds are now, U.S. Treasuries, long dated. If you had 30-year Treasuries, they've, in the bear market of the first 6 months of this year, from January to June, U.S. 30 years fell just as much as the S&P 500. You lost 20% on both. And so it's you're now in a situation where, if you think, okay, U.S. Treasury was my offensive line of my American football team, they were there to protect my other assets. Now you have an offensive lineman that weighs 130 pounds. And that's what U.S. Treasuries are today. They're an offensive lineman. They're a peewee offensive lineman. And you're trying to play them in the NFL. It's just not going to work. And so the real challenge is, where can I find assets that are properly anti-fragile, that are going to cushion? I can find growth stocks, I can find value stocks, I can find exciting stories, but what I need is an asset that's going to protect me on the downside when, for whatever reason, Russia invades Ukraine, or whatever else comes out of the blue, things go to pot. Now, knowing that U.S. Treasuries aren't it anymore, is it gold? Gold hasn't really worked this year for that purpose. For me, what's interesting is, in this year, two assets have managed to do this for you. The first asset is energy. If you look at energy, it increasingly behaves as anti-fragile in that when the market goes down, it tends to go up. And when the markets go up, it tends to go down. And so energy is now the which makes sense, because if you're in an inflationary environment, a lot of the inflation is likely to come from energy. The real risk in our system today is that oil ends up at $150. That's the real risk. It's not that the Fed hikes another 50 basis points. The real problem is if oil goes to 150. That's when the system implodes. And so I think your first anti-fragile building block today is energy. Your second, and here this might sound somewhat controversial, I think, is emerging market bonds. You look at how the big emerging market bond markets have evolved this year. China, South Africa, Brazil. I'm not going to say Russia, of course, because that's a special case. Indonesia. A lot of these bond markets are flat to up for the year. The Chinese bond yield this year has gone down from 3% down to 2.65, 2.7, while the U.S. bond yield has gone from 1.5 to 3. Which is very odd, because it's not what you would expect. If a year ago I had told you, look, Dave, we're going to be the Fed is going to be more hawkish. Inflation's coming around. Oil prices are going to be high. Fed is going to tighten more than people expect. Oh, and by the way, buy emerging market bonds. You'd have said, Louis, you're an absolute idiot. Don't you know that when the Fed tightens, you don't buy emerging markets, you sell them? That's been the case in every Fed tightening cycle, but not this time. So this time something odd is happening where things like Brazilian bonds and Chinese bonds are massively outperforming amidst a Fed tightening cycle. I think there's an important message there.
Well, it's an important one, and it's actually music to my ears, because that's been one of my favorite asset classes, is to look at emerging market debt as that anti-fragile asset, and one that generally has a pretty good yield, too much higher than. But it has been, well, before we move off, I want to say to our viewers that we do have an image here for the structural inflation, and I do want to make a point about that before I want to get back to emerging market debt in a moment. But if you look at this visual, what it shows is the CPI in a very tight range for basically all of the 2000 teens. And then starting that time that you were talking about, the spring of 2021, that inflation breaks out to the upside. I mean, I've learned over the years that macro data is a lot like stock charts, that when you see a major breakout of something like inflation, you should pay attention to it, which of course the Fed's 400 PhDs didn't do. They completely ignored that signal. This was clearly saying inflation is going to be a big problem. So that's very apparent on that particular visual.
On this, sorry to interrupt you, Dave, but I think this is very important. I think it is very important. I think if you're working at the Fed, if you're one of those 400 PhDs and you're tasked with building a model for inflation, for 30 years, inflation was mean reverting, because you had all these deflationary forces in the world. The China entering the WTO, the acceleration globalization, China unleashing 20 million workers onto the workforce. For 30 years or so, inflation was a mean reverting, like a mean reverting stock. And now all of a sudden it isn't. So do you assume my model is broken? Do you assume the inflation regime has changed? I think initially the tendency was to say, oh, well, my model is fine, inflation will come back. It's just, overshooting. It's COVID linked, it's this, it's that. But the longer it continues, the more obvious it becomes. The models, inflation has changed its nature. Inflation is inflationary. It feeds on itself, and we've entered into a new regime. And that's where we are. We are in this new regime. And these 400 PhDs who all basically built models that were all mean reverting can scratch those models. They're now worthless and start again. Sorry to interrupt.
No, it's very well said, and they seem to be very reluctant to do that. I've made the point that the Fed, with all its computers and PhDs, probably should invest in a dartboard. It could really
look at it this way. If you'd spend 2 years or 3 years or 4 years of your adult life building an inflation model that was peer reviewed and you got big taps on the back, et cetera, for how great it was, you'd be reluctant to scratch it. You'd be reluctant to say, "Oh, I'm putting this one in the bin. Sorry, this one's on me. I messed up. Sorry." You'd be
the
reluctant.
Fed has proven repeatedly that it's very reluctant to admit that it was wrong. So let's talk about, because this relates to emerging markets, the international liquidity crisis that your dad Charles has been discussing quite a bit. We've got a chart here that makes the case that it's clearly unfolding. And so I know that you don't always agree with everything your dad says, although generally you're a good friend.
Who agrees on everything what their dad says? You've got sons too.
It's in our case, it's very rare, but it's another story. I think French children are more respectful of their parents than American parents. So, do you agree that is happening right now? I mean, you kind of touched on it, saying that that's the one thing that really could kind of help fund the U.S. deficits, is if there's these rolling crises that cause money to flow into the United States. But how severe do you think this is, and do you think that puts the whole bullish thesis on emerging market debt, at risk?
I'm of two minds about it. On the one hand, it's hard to ignore the evidence in front of your eyes, right? I mean, we have all the evidence of a typical liquidity crisis, like I mentioned, Sri Lanka going bust, and Argentina, and all these places hitting the wall. So that's one side. On the other, you got some odd things develop at the same time, right? Indonesia outperforming, and Brazil outperforming, and Chinese bonds outperforming. The kind of things that don't usually happen in a liquidity crisis. You remember the taper tantrum when the Fed first announced that they were going to do QE back in was it 2013, I think.
When they were going to taper. When they were going to taper.
When they were going to do when they're going to do a QT, and back then people were talking about the fragile fives, right? And the fragile fives were India, Indonesia, Brazil, South Africa, and Turkey. Well, 4 out of these 5, leave Turkey aside because that's sort of a special case, but the other 4 are actually doing fine right now. And so, you wouldn't expect that in a liquidity crisis. Now, so all the signs are there that we should have one. At the same time, when you think, okay, perhaps why are we not having one? Well, there have been some changes to our international financial architecture in the past 10 years. And the big change, of course, is the internationalization of China's renminbi. And the fact that China can now go to places like Indonesia and say, look, if U.S. banks won't fund your trade, we'll fund it for you, and we'll fund it in renminbi, and we're now your biggest trade partner. So all of a sudden, things like the Indonesia to China trade that used to get crushed when American banks retrenched because of a liquidity squeeze, all of a sudden that now gets funded. But perhaps the biggest change of all on this front has actually happened with the Ukraine war. China's been going to Russia for the past 10 years and saying, hey, listen, instead of trading in US dollars, why don't we trade in renminbi? When we trade in US dollars, we put the US Treasury in between us because the US Treasury can look at any one of our transactions. So instead of having a committed relationship, we end up in this ménage à trois with the US, and we're not really keen to have the US in between us. So, and Russia was always a bit lukewarm on the idea. It's like, yeah, but what am I going to do with these renminbi? And now all of a sudden, Russia doesn't have a choice. Since we've imposed all these financial sanctions on Russia, Russia now turns to China and says, yeah, I'll sell you iron ore in renminbi. I'll sell you natural gas in renminbi. I'll sell you US dollar. I'll sell you oil in renminbi. So all of a sudden, if you're China, you no longer need as many dollars as you used to, right? Why would I need all these dollars for? They needed these dollars to buy the commodities, and now they can turn and buy these commodities. I don't know if you saw, but 3 or 4 weeks ago, China did its first deal with BHP in renminbi. So it bought a bunch of iron ore from BHP, and the trade settled in renminbi. Now that that's happened, all of China's iron ore trade is going to be denominated in renminbi because China's going to tell
an Australian company, right? That's an Aussie company. BHP.
Yeah, BHP. Yeah. Broken Hearts and Promises. Yeah. It's the biggest Aussie iron ore producer, copper producer. But now that they start to accept renminbi, China can turn to Rio Tinto, can turn to Vale, and say, hey, look, I'd love to do business with you, but you got to match BHP's terms, right? And so all this to say that if we move, the reason you have a US dollar liquidity squeeze is not enough dollars. And typically one of the obvious reasons is often the energy price goes up. And as the energy price goes up, people need more dollars and there's not enough dollars to go around. That's what's happening in Sri Lanka and Pakistan. But if now Russia says, hey, I'm open for business and I'll take your Indian rupees, I'll take your Thai bahts, I'll take your Korean wons, I'll take your Chinese renminbi, then that's a weight off on the US dollar liquidity squeeze. So that's why I'm of two minds about it, because genuinely, I feel like the market is changing under our feet. So in normal times, we would have a full-blown US dollar liquidity squeeze right now. But I think we shouldn't discount the fact that the world's biggest commodity exporter, namely Russia, and the world's biggest commodity importer, namely China, are now moving to de-dollarize their commodity trading.
Right. But I think it is important when, there's the old saying that in the U.S. stock market, it's not a stock market, it's a market of stocks. I think when it comes to emerging market debt, it's a market of bonds. So there are certain countries, and you mentioned some of them, where you wouldn't want to touch the bonds with, as you would say, a barge pole. But there's others like Indonesia, where, in the old days, you might have think that is kind of a weak country, but they've done a lot to improve their balance sheet. They're running trade surpluses. Their inflation's lower than our inflation. They've got real interest rates. So there's some of these emerging markets that, it's almost like things have inverted, that the developing world is following more emerging market policies and the developing world's following more developed world policies. Not in all cases. That's why it's really important to do research, really important to be in the right countries. But it does seem to me that the West is just deteriorating. It's in a structural decline phase. That's, as an American, I find it appalling and very distressing. But I have to recognize reality as it is.
Look, I think when it comes to emerging markets, the landscape is changing very rapidly, but is, to your point, fully binary. At this point, you have the emerging markets that aren't going to make it, the Sri Lankas of this world, partly because of knuckle-headed policies, and the others that are actually have been, the big differentiating factor was COVID, right? During COVID, most of the Western world decided to follow crazy fiscal policies, crazy regulatory policies, and crazy monetary policies. And most of the emerging countries didn't. Most of the emerging countries didn't say, you know what, stay at home and we'll send you $2,000 a month for you to play Nintendo. And there's a cost to that. And it turns out that cost is higher inflation and currency debasement. And no other emerging market country is turning around and saying, oh, look, we're very sorry you had to borrow money to go to university. We'll pay you back $10,000. Nobody does that in emerging markets. And so, yes, you don't end up with the higher inflation because, as Milton Friedman once said, there's no free lunch, right? You tell everybody who went to college, here's $10,000. Somebody's got to pay for that $10,000. And that somebody at the end of the day is going to be higher inflation. So really, the poor schlub who doesn't go to college gets to pay twice. He pays for the guy who goes to college through his taxes, and then he pays again through higher inflation. Because higher inflation, let's not kid ourselves, it's a tax on poor people.
Absolutely, it's very regressive.
But then, as Mark Twain said, maybe we should tax poor people. There's just so many more of them.
That's a good one. Well, we've been going over an hour, and that's actually a pretty good lead into. I know I'm putting you on the spot again here, but your favorite story in your career, you've got to have some great stories. Is there one or two that would be at the top of the list?
Well, I would say, I think when you're younger, the stories mark you more, right? The wounds you get as you're younger mark you more. And so in '98, August '98, you remember LTCM's going bust, and it's mayhem everywhere. And we're over a year into the Asian crisis, and my dad calls me up and tells me, "Look, I think Asia's fallen hard enough. It's things are bad. I want you to find 10 good companies in Asia. 10 stocks that aren't going to go bust. 10 good quality stocks that you're going to buy. You're going to make a list for me, and I'm going to put $100,000 in each 10 stocks. I'm going to put $1 million and put $100,000 in. And at that time in my career, I'm working at Par, but I'm probably earning like $40,000 a year or something. And so I buy the 10 stocks. By October, that portfolio was down 55% in like 6 weeks. Like 6 weeks. Between August and October, it had fallen 55%. I would come into the office, turn on the Bloomberg, and I just wanted to throw up. I'd lost like basically 10 times in the space of 6 weeks, 10 times what I was making per year. By December, it had come back to even. By March, it had doubled.
Wow.
And
he stuck with it, I bet, knowing Charles.
No, we stuck with it. Of course, he stuck with it, and then he's like, he divested later on, like years later. So that was with the benefit of hindsight, that was a lot of stress early on in my career for my little shoulders back then. I was 22, 23. So that was a deep formative experience of
Absolutely. Well, I'm sure glad for the relationship between you and Charles that portfolio rally. You're making
Yes.
money, but it does go to show what happens, because obviously there was an enormous bubble in Asia that popped in the late 90s, and one, of course, in Japan that was even more spectacular. One of the interesting factoids I've come across lately, and maybe you've seen this too, is that the Japanese real estate bubble of the late 80s, very early 90s was considered to be the biggest real estate bubble of all time. But actually, if you look at Australia, if you look at the property market as a percentage of GDP, it's actually greater than it was in Japan during the height of that bubble. So it tells you, and I guess maybe
I don't know about that, because the prices in Japan were so crazy. Because I think if you look at a shop, worth more in California, and if you look at, there was a shop in Ginza, 100 square meter shop that sold for over $1 million US a square meter, and this was in 1989. It was $1 million, was still a lot of money. $1 million US a square meter. Like, you haven't reached those kinds of stupid valuations in Australia. I'm not saying there's no bubble in Australia, but I think Japan will be hard to beat in terms of sheer madness of the prices that you saw.
Yeah, I don't know how it was calculated. It was actually from our mutual friend Gerard Minnick, but who is based in Australia. But there's no doubt that at least in my mind, what we saw last year was the biggest bubble in recorded human history. It's just so many things going absolutely parabolic at the same time, which leads me to just show you.
Well, what was insane? Yes, I meant to plug it. I'm sorry.
No.
It is a terrific read. But to your point, and I know you highlighted it, and I know your book is a compendium of things you wrote over these past couple of years of crazy prices. What was amazing in the bubble of the past couple of years is how a lot of things, typically things have value either because they have a utility, i.e., they're going to produce a cash flow over time, or because they're rare, i.e., a diamond, a Van Gogh painting, a Petrus bottle of wine. And what was amazing in the past couple of years is you had a lot of things that shot up in price that were neither. They were neither rare, nor all these crypto coins, all these things that were neither rare. You want them either to be rare and beautiful, again, like a Petrus bottle of wine or a Van Gogh painting, or to be useful, producing cash flow. But these things, they neither produce cash flow, nor were they rare. So you looked at this and you can. Tokyo real estate got to be stupid prices, but at least it was rare. Like if you were in Ginza, there's only so much land. So somehow, in some kind of twisted way, perhaps you could justify it as there's only so much land in Tokyo. You could at least spin a yarn around it. But some of this stuff, it was genuine head scratchers.
Oh, absolutely. No, total head scratchers. And Dogecoin being the one that I really home in on, because it got up to an $88 billion market cap for something that was a total joke. And really even made the meme stocks look like bargains by comparison. Well, I do want to thank you for not only being here, but also the support you gave me in writing my book. That was a major undertaking, and your encouragement was invaluable. So Thank you for that.
Not at all.
One thing, and I apologize for this, one thing that we missed, and we are running along here, so just maybe a quick view of what's happening in China with its real estate bubble popping. And we do have a visual from Gavekal on the collapse in floor space under construction. And that really does, I think, have global implications, right? Because
for sure,
the demand for so many commodities has been driven heavily by China, and a lot of that has been for the construction boom. So just as kind of a closing note, what's your take on that?
Well, in terms of the global consequence, I'll go into China in a second, but in terms of the global consequence, I'd highlight that, if we're right, you and I, that we are entering some kind of slowdown and, recession in Europe and at least a significant slowdown in the US, this will be the first slowdown in my career where you're not seeing Chinese growth sort of pull the global economy higher. If you go back to 2008, China basically made the bottom for the global economic cycle, right? The Western world fell apart and Chinese growth reaccelerated thanks to a big stimulus and got things going again. And same story in 2015. And today, Chinese growth is slowing down. So here we are with a global slowdown and a China slowdown. So it's, in that regards, it's a bit scarier than previous slowdowns, right? Because we can't count on China to do some of the heavy lifting this time around. Now, I think there's a number of issues in China right now. The biggest one, as you highlight, is the real estate. Of course, there's the zero COVID policies don't help. The political uncertainty that you've basically moved from management by committee to management by one man, that also doesn't help. But the real estate thing, and the best parallel for the real estate thing is it's somewhat equivalent to a banking crisis, in that if you go back to the 1930s in the U.S., people took their money out of the bank because they were worried that the bank would fail. And so the U.S. government had to invent the FDIC, and then people felt comfortable keeping their money in the bank. In China today, the way the property sector works is that, if you want to buy an apartment, you put 30% down, which most likely represents your life savings, and maybe you've even borrowed money from friends. And the property developer takes that 30%, then leverages it up with the bank and builds a building. And then 2 years later or 18 months later, you get your apartment and you borrow the remaining 70%. And if the property developer goes bust in the process, then you've lost your 30%. And this is the big problem, is you've had a bunch of property developers that have gone bust. And so nobody wants to buy anything anymore because everybody's worried, I'm going to lose my 30%. So it's a little bit like fractional reserve banking.
Mm-hmm.
And once you lose that confidence of the base and the money starts to come out, everything collapses. So really what China needs is the equivalent of an FDIC scheme, but for property developers, where you need some kind of insurance where people feel confident that they can put their deposits, and even if the property developer goes bust, they'll get their money back. And there's a lot of rumors right now going around that this might happen. Part of the problem is we have the Party Congress in October, November, and it seems highly unlikely that any major policy decision gets taken before then. This is the kind of policy shift that will get announced after the Party Congress. So for now, we're sort of, everybody is sort of in the wait and see zone. But so as you look forward to the Party Congress, which is October, November, for me, there's two big questions. Do we get some kind of insurance scheme, such as the FDIC, but for property developers announced? That'd be quite bullish. If it doesn't, that'd be bearish. And is Xi Jinping confirmed as dictator for life? Or does he just get one more term and they say, okay, in 5 years, this guy will be president, this guy will be premier, in which case the market will love that. And anything that smells of management by committee rather than management by one man, the markets would rally heavily on. Obviously, I have no idea what the Politburo is going to be doing. And anybody who claims that they do is lying or is a member of the Politburo themselves. So I think we just have to wait and see. We'll know more in October, November. But the possibility, Chinese stocks are so beaten up. A lot of them are so cheap. I've been buying them lately because I think the optionality going into the Congress is actually pretty decent. If if Xi Jinping is confirmed as dictator for life, I think that's what the market expects already. So I don't think the markets sell off on that news. Meanwhile, if he gets his wings clipped, then the market's ripped like crazy. So it's sort of a heads I win, tails I don't lose so much proposition at this stage for me.
Yeah, makes sense. That's really quite an intriguing point about the potential for insurance. That makes a lot of sense. Well, Louis, thank you so much for everything.
Pleasure.
And as usual, just really articulate and just a font of information. So thank you, thank you, thank you.
Absolutely, my pleasure. And congrats again on the book. It really is a great read. And I know I've been a little late. I got to do the book review for the Gavekal clients so that they all rush to buy the book.
I appreciate that very much. All right, my friend, we'll be talking soon.
Take care.